Welcome to Ask the Experts. I'm Jill Schlesinger, editor-at-large of CBS MoneyWatch, and I'm joined by...
Jack Otter, executive editor of CBS MoneyWatch.
Oh, Jack, I thought this was going to be a boring holiday show, and in fact, there's something to talk about. The payroll tax cut extension. We seem to have hit a roadblock, my man.
Wow.
And, well, I think Speaker Boehner could really get hurt on this one, I got to tell you, because...
You think?
Well, I don't get it. Both sides want to extend the payroll tax cut, okay? So if you don't remember this, what happened was last year, sort of a stimulative effort from instead of paying 6.2% in that little line item on your payroll stub that says FICA, you don't pay 6.2, you pay 4.2%. That's about $1,000 extra a year in each working American's
pocket. For the
pocket.
average paycheck.
Average guy, right? 50 grand. And you make more than that, it's up to $106,000. $106,800 is the Social Security wage base. So the whole point was that Congress said, hey, we all like this. We want to keep doing this for next year. But the Senate couldn't quite figure out how to pay for it. They come up with something. They say, let's push it out for 2 months. We can all go on vacation, chill out, ring in the new year, get back to work.
Classic 2011 congressional Senate move, yeah.
The worst, right? And so now goes to the House. Over the weekend, Boehner goes on the air and says, we're not going to do it.
And you were wrong when you said it was the worst.
Really?
It then became the worst when Boehner made it even worse and said, well, no, actually, we're not going to pass it. Senate has to come back and pass it. Obama needs to help out. He needs to make more compromises. And, of course, Obama and probably Harry Reid were watching the polls, and Obama's performance has gone like this, so he is in no hurry to fix this.
Yeah.
And I knew things were bad for Boehner when you open up the Journal this morning, and the top editorial page is going after John Boehner. That's like when my mother-in-law gets mad at the kids, I know they must have done something really bad, because Grandma never gets mad at the kids. And same with the Journal and Boehner.
Absolutely. And I think what's interesting is the journals may not like this. Nobody wants to say, thinks that this is a way to stimulate jobs. But it is stimulative, okay? Obviously, extra dollars cycling in a weak economy is a form of stimulus. So
and then, don't take it from us. This is it's politics, and people will argue over this. But the fact is, when you hear any, Tobias Lefkowitz was on CNBC. I have no idea what Lefkowitz...
What? Is that station still on the air? Oh, okay.
I have no idea what his politics are, but he, like every other mainstream economist strategist, it's very simple for them. They subtract 1 point from next year's GDP if this thing doesn't go through. And they're not being political. They're saying, that's the best crunching of the numbers.
And so I should also say this plus the extension of unemployment benefits for the long-term unemployed. So the two things together would shave 1% off growth next year. And let's just kind of get our heads on straight, gang. We're only looking at 2% growth next year. So we're talking about a 50% reduction in growth if Congress doesn't get its act together. What do you think's going to happen, Jack?
Gosh, it doesn't really look like they're going to do it in 2011. I don't see quite how it happens. There is zero incentive. I'm being cynical here, but from the Democrats' perspective, there's zero incentive to do anything. They can just ride this and watch their numbers go up while the Republicans go down. The only thing I could see is maybe somehow Boehner gets religion and gets his caucus in the House to say uncle and pass this. He comes out looking pretty bad. I mean, that will be listed as a loss for him. But it might be better than just dragging this thing out.
Now, for those people who say, oh, isn't gridlock good for the economy? This is an example of, no, it's not. And now the interesting thing is investors aren't quite on board with this not happening. So the reason why I know that is, we had a very strong day yesterday in stocks. This is all on light volume, so everyone ignore it. But but it's okay. Maybe we'll finish in the black for the year for, maybe the S&P 500. We're already in the black for the Dow. Today, after this whole brouhaha with Boehner, stocks basically meandered to a flat line for the end of the day. Dow was up 4 points, NASDAQ down 25 points, S&P up a couple of points. I think investors don't think that the extension's at risk. They may not like the timing of it, and maybe it'll happen when they get back, but I think that investors believe there will be an extension of the payroll tax cut and unemployment benefits for the long-term unemployed, and they're voting that way with the way the market's moving.
Yeah, I think there will be, too. I think the question is when, and I could easily see it being pushed into January. People in payroll are going to hate this whole system because what they'll have to do is do some kind of a retroactive thing where your second paycheck of the year will reflect a refund of the 2 percentage points in FICA. It's just going to be a mess. I think that's probably what will happen.
Yeah.
And so we'll get our stimulus, but it'll be yet another example of this dysfunctional Congress.
Yeah. And by the way, this is the least productive Congress since 1948.
Wow.
Meaning the fewest number of bills passed.
And it's not as if there was a high bar for them to clear. This isn't an organization that's been running at full steam recently. Wow.
Yeah. And so for those of you who I know we promoted this and we were talking about some of the sort of what's happening right this second. Also want to note we are going to be talking about year-end tax tips, and we're going to have a fabulous guest. But before we get to that, just a little bit more here, Jack. CBS News poll out today. 40% of Americans say the economy is, quote, very bad. 41% say it's fairly bad. Now, I'm not great at math, but I add 40 and 41. That sounds like 81% of Americans say, the economy's not doing too well.
I would love to see this. I don't know what the numbers were, say, in 2009. But I'd love to compare them. I suspect it was not as bad.
Yeah.
And so I actually take this, certainly from a market perspective, as a really good sign. Because, no, the economy's not great. Americans are correct. But we're certainly a heck of a lot better than we were in 2009. And so I think we're more likely to be surprised on the upside. I think that's exactly what happened in the market yesterday. It's not as if we were bowled over by fabulous news. It was just the news was a little less bad than, it was more good than bad, and therefore the market went up.
You know what this country's motto should be? At least we're not Europe. That's really what we should be. I mean, look, the economy is in a slow growth mode, but it's growing. And, we're finding out that many countries in Europe are now starting to report some third and fourth quarter numbers. They're going negative. And if things don't get resolved next year, I think that is a huge issue that we face, a big headwind, far more important actually than even the payroll tax cut.
And the lead story on MoneyWatch.com right now is that the U.S. Stock market was actually only beaten by 2 emerging markets. All developing markets did much worse than we did this year.
Sell everything right now. That's interesting because it does show you that as much as we feel bad right now, it's almost like how consumer sentiment doesn't always match up with consumer spending. I feel really bad. The economy is terrible. And yet you look at some of the retail sales figures and they've actually been better than expected in the last few weeks and a few months. So, we got to see how the year shakes out. I guess that we're going to end up with about 2.2% growth for this past year. And considering all the nonsense that's gone on in Europe, it's not horrible.
But you say that I'm cynical and all this stuff. Well, I'm going to be cheery for the Christmas Hanukkah season here, and I'm going to say that I think we are much more likely to be surprised on the upside in 2012 than 2011. I'm not being Pollyanna here. I just think that, like you said, everybody thinks that everything is awful, and I think that if there is a surprise, unless the European collapse happens, then all bets are off the table. But my guess is we're going to sit here in a year and say, wow, we had 3% growth or 2.75% growth.
Last weekend, Barron's had its sort of annual look ahead, and the average stock market rise came in at 11.5%. Okay, bunch of different analysts, with one little caveat, except for Europe. And every single person says if Europe implodes, then obviously all bets are off the table. I still think that's a pretty big risk.
Yeah, absolutely. And that's why the market has done nothing for a while.
Right. Although if I could say, if we were in August at the debt ceiling debacle and we were going up 4%, down 4% every single day. Remember when it ruined my vacation?
Oh, yeah.
Remember that? And someone said to me, you'll finish the year flat if you just shut up. I would have taken that all day long.
Yeah,
I was
absolutely.
really much more nervous because I am nervous because I'm a Debbie Downer. I'm sorry.
And think about the people who did just sit tight. They didn't do anything. And maybe on some of those worst days, they said, what the heck? And they threw a little money in. So they're finishing better than flat. Good for them.
If you think about it, if you have a balanced portfolio, I can't wait to see Alan Roth's numbers because he always does this. So let's see what his numbers are for this year. I bet a balanced portfolio is up this year. Right? Because,
absolutely.
it depends what kind of bonds you own, because treasuries maybe not gone up so much. But if you own corporates or munis got marked down a year ago because of the Meredith Whitney factor. Meredith. So bad. Wish I hadn't said that on 60 Minutes. So that said, I think it's going to shape up to be an interesting kind of going forward year and see how people's expectations come into line. And for now, I think what's kind of interesting is that we do have a few things that we can control. We can control how much we pay in taxes.
Yep.
Sometimes.
Not
always.
Yeah.
Okay? So before we go to the year end, we must bring in our expert. Bob Meighan from TurboTax. And Bob, hopefully you're there and you're with us and you can hear us, because I'm not sure. You there?
I'm here.
All right. Whoa.
I'm here, Jill and Jack.
Excellent.
Good to be here.
All right, hold on. I'm going to do your intro, because first of all, he looks very casual today. I think last time we saw you, you were wearing a tie. But Bob's a CPA. He's a CPA. He's vice president of customer advocacy for TurboTax. He's the past chairman and member of the Electronic Tax Administration Advisory Committee. That must be a rousing crowd. You know, that crowd would be awesome. I love it. Prior to joining Intuit in 1991, he spent 11 years with the accounting and consulting firm Pricewaterhouse, where you may have heard. Anyway, he does a million things. And Bob, thank you so much for joining us, because we just have 6 trading sessions left for people to actually, is that right? 5 or 6. We have tomorrow and then 4. We have 5 trading sessions left, no Monday session. So we've got 5 trading sessions left for people to do some stuff. And so let me first ask you, what's your favorite year-end tax-saving tip?
Wow. Well, the favorite one?
Yeah, your favorite.
You know, I would say the one I would focus on that most people tend to overlook is the donation one. And we're not talking about cash donations. We're talking about donating household items like clothing, furniture, toys. You know, people often use this time not only to shop for the holidays, but also to clean out the closets. And just people tend to forget that you can take a write-off for the value of those items that you contribute to charity, including mileage that you incurred to, you know, drive those items down to the local Goodwill or Salvation Army. So that's, I think, just a very valuable one that people tend to overlook at this time of year.
And Jack, what's your favorite year-end tax tip?
Well, it just changed. I'm going to donate all the stuff in Miami. Because I didn't realize I could deduct the mileage, so that's
there
great.
There you go. Well, hurry up and go down there. Yeah, now what?
No, you know what my favorite one is, of course, because we all unfortunately have it. It's the tax loss selling. We always tell people, you know, buy and hold, buy those index funds, stick with them. But the fact is, we know people don't do that. People maybe at this table, maybe you're looking at them occasionally, will dabble in an individual stock and be reminded why he tells people not to do that.
That's good.
And so selling for tax loss selling does not actually violate buy and hold, because what we suggest is that you harvest those losses. Don't sit there and wait. There's a psychological desire to wait till it gets back to even and then sell. That doesn't do you any good. Sell it now. You can then reinvest in a close but not precisely equivalent investment. Jill and I would just say probably an index fund is a better way to go. But take that loss, put it against any capital gains from taxes you might have sold, and then up to $3,000 against ordinary income.
And you know what I love? I mean, I think it's a great way to clean up your portfolio. So forces you're going to do this year-end rebalancing anyway, clean some stuff up. You know, no one's a genius in this business. You're going to be wrong half the time. You really are. So you can clean it up, use the tax code to your advantage. I love when you sell a loaded mutual fund at a loss and replace it with an index fund. It seems to me like a brilliant thing. You've got the ABC stock mutual fund. You sold it. You bought it through your bank for some godforsaken reason. Now you're down money. Sell it out. Go straight to your favorite no-load mutual fund. Go out and replace it with an index fund and go to sleep at night. Now, I will say, Bob, that my favorite tax deduction that's expiring this year is some combination of both of what you and Jack were just talking about, the IRA charitable donation. I find this to be one of the coolest things I've ever heard about. I just said to my father, like, you got to do this. So if you're over 70 and a half, you can contribute up to $100,000 of your traditional IRA assets directly to a qualified charity. Now, here's the difference. When Bob tells you to go contribute something, you're going to get a tax deduction. You get a charitable tax deduction. But if you go and gift something out of your IRA, you're not going to get the deduction for that. But the money you pull out of that IRA account is not taxed as ordinary income. Sweet! And it can actually cover your required minimum distribution. This actually is over as of the end of this year. This was a special deal for 2 years. And right? Is that right, Bob?
Yeah, no, it's a great deal. Yes, and it's a great deal, particularly for those taxpayers who have quite a bit of money tied up into their IRA, and they may not necessarily need to take that distribution this year because they don't want the income, and secondly, they don't want to be taxed on it. So it is a great way to sort of reduce your IRA holding while also doing a great service to the community by donating it to a local charity.
And one thing, I did speak to another CPA who said to me, be very careful. You can't pull the money out and then gift it. You has to go directly from your IRA to the charity, and donor advised funds are not qualified charities, so you can't do it there. Okay, let's get on to right?
That's absolutely correct, because doing what you just said not to do would cause you to be taxed on it. That is not what you want to do.
Definitely not. So let's get to some of these questions. Kimberly from Florida writes, I was laid off on May 1st, 2001. The good news is I'm close to a new career. Woohoo! I'd like to know what I should be aware of that will benefit me, having been unemployed since May 1st. I do receive unemployment. I have them take taxes out. So Jack, looking at the new job and looking at your general tax liability, what should Kimberly be thinking about?
Well, one thing is that she presumably had a pretty extensive job hunt if she's actually changing to a new career. So there might be deductions, that she'll be able to take based on that job hunt. Obviously, every time she FedExed her portfolio or resume to somebody, that's a deduction. Travel to the job interviews. We'd love to say that she could deduct those fancy clothes she bought for the job interview, but that's a dodgy one. We'll ask Bob, but I don't think she's going to get away with that one if she'll be wearing those clothes again. But she might be able to get some deductions from the job hunt.
If she got a coach or she did a resume prep, Bob, that's also deductible as a related expense associated with a job search?
That is correct, and I agree with Jack that, you can push the line on some of those, but the real problem is the fact that the job search expenses can only be deducted to the extent they exceed 2% of your adjusted gross income, and then also only if you itemize your deductions. So that's somewhat of a pretty high bar for some people to reach.
So if you have unemployment benefits and maybe you got paid for the first 5 months of the year, so maybe that income together puts her there, but again, she has to itemize.
That's true. So, you have to look at her income just to kind of figure out where she is. But, the other thing I would add to that, you have moving expenses. So if she actually moved to either look for a new job or to take that new job, moving expenses would be deductible. And the good thing about that is that those are deductible what's called above the line. So in other words, there's no threshold. You get to take that even if you don't itemize your deductions.
Oh, interesting. And Bob, I have a question for you. I got a question about this on my radio show. And I had a guy call up and he said, I live in Wisconsin. I'm a resident of Wisconsin, but my job relocated me to Texas. So I went to Texas. My family's still in Wisconsin. They live in the house that I own. I'm renting down in Texas. Are there any costs that he is incurring that are tax deductible, anything other than just miscellaneous business expenses in excess of 2% of your AGI?
No, I think you about covered it there. It's just those that are, specifically related to the job. Unless he had some business in, I think you mentioned Wisconsin, then he may be able to associate some of the expenses with his business. Maybe it's a rental or investment property. Right. There could be some attributable to those, up in the other state.
All right. Very good. Okay. Now here's a question from Jonathan in Texas who has a dilemma. I've been unemployed for 2 years. In 2001, I received unemployment benefits, but I never had taxes taken out. Jack, this is a big deal because people are living on...
Would this be 2011? Must be.
Yeah, in 2011. And he said that in 2011, he's never had taxes taken out because the money was tight. He needed to pay the bills.
Ouch.
Right? So that's a terrible situation. A lot of people are in that. His income, $21,000. His wife's income expected to be over $50,000. Filing jointly, I think we will be in trouble and owe significantly more in taxes than we can afford to pay. What are your recommendations? Would filing individually help? We've been married and living together and filing jointly for 21 years. Would the change pique the IRS's interest? So what do you think, Jack?
I don't think it would help them. That's the bigger issue. Filing separately at this point, especially because they're going to, there's the question, did you file jointly or separately last year? It'll be, no, we filed jointly. So that's not going to help at all. I think it sounds like they're going to need to obviously file an income tax return, pay what they can, and then set up a plan with the IRS to pay over time.
Right, and Bob, there's you can do an installment plan, but can you also apply for maybe a hardship? Because I know there's a form. I'm pretty sure that isn't there a hardship appeal that you can make where you can cut a deal with the IRS?
Well, you can appeal for a hardship, but the bottom line is they're still going to end up paying the tax sometime in the near future. And I agree with Jack. The best course here is to file an installment payment plan with the IRS, and they are relatively not forgiving, but they are very lenient in terms of setting up those plans. So that's the course that I would pursue.
Right, and here's the one thing to remember, Jonathan, is don't use a credit card because the IRS hoses you on credit cards. I mean, it's crazy. And don't do, what is that called? A refund anticipation loan? Isn't that what it is? It's right. And so like I know we did a story on that. That is also like you're paying a ridiculous amount of interest. So work with the IRS. They know that people are going through hard times. They got to do it that way. Kimberly's husband received a substantial severance package this year, about 46 grand before taxes. What would be a smart way to handle the money from a tax perspective? Our annual income was approximately $110,000 before taxes. We have not yet maxed out our 401k contributions. Jack?
Well, the problem is there's no magic bullet here. That was income. She's already received it. If he could have negotiated ahead of time, if anyone else is in this situation, you might ask your employer to defer some of that severance until next year. But the bottom line is they're going to have to pay ordinary income tax on that $46,000. Now, the 401k could be one clue. If they have the cash flow to afford it, I would absolutely recommend putting as much. Can they max out their 401k? If there are two of them, they could put $32,000 in the 401k, and that would certainly drop their tax bill. I realize from a cash flow perspective, they may not be able to do that, but I would certainly recommend it because you'll find that if you put say $10,000 into your 401k, you're actually going to only end up, and I'm not good enough at math to tell you off the top of my head, but you're only going to have, say, $7,000 less than you would have if you hadn't put anything in at all, and that's because you're not paying tax on that money.
And Bob, what if we could go back in time and kind of recut the severance package? Do you think it's worthwhile for people to spread these kind of bonuses or severance packages out over a couple of years?
Well, you know, the severance package will be taxable as regular income, but as you suggested, it does make some sense to perhaps try and spread it over a number of years, or at least spread it out, and thereby you're not taxed all in one year. Now, you got to also look to the future, and you have to make an assumption in terms of where you believe tax rates are going to go. If you believe tax rates are going to go up in the future, which is what many people suggest today, then you may be better off taking all the money this year and just paying the tax on it and getting going forward, because the tax is going to be less than what it may be in the future if you believe those rates are going up.
And there's also the question of what their situation will be next year.
Right.
So I don't know if he's already got a job or not, or if anyone in the situation already has a job. But even though rates might go up, your personal tax rate might go down if, say, only one of you is employed next year. So that's another reason why it would be an advantage to have put off at least part of that.
All right, here's one.
And if they have kids, of course, the 529.
Yeah, 529 is
that won't
a sweet
get you
one.
a federal break, but it will, in many states, including New York, will get you a state tax break.
Absolutely. And if there's, and you know, I think that you go back, if again, you look for any possible deduction you can possibly find. Here's another question who's from C. That's it, letter C. I have inherited some penny stock. Original cost is actually 1 cent. My husband and I usually have to sell some each year to help pay our taxes, which then causes a large capital gains tax. I'm considering cashing out some of this position to get out of the roller coaster stock market. But again, I'd have to pay a large capital gains tax. By the way, you know, my father has a saying about this. He goes, those who worry about paying capital gains will soon have nothing to worry about. Don't worry. So the question is, are there any other options how I should liquidate this stock? Should I gift it to my children? Should I have them sell it? So, Bob, what's your best advice on this? Gifting appreciated stock.
Yeah, I think the best thing for her, given that it sounds like she is open-minded about giving away the stock, it doesn't sound like she needs the income, I would consider donating it to charity where you can get a write-off at, I believe, the fair market value of it. And it is one of the best tax moves in terms of making a donation. So that would be my recommendation, is to donate it directly to charity.
But we may be able to save her a whole lot of money here. It's a cryptic note, but I hope they know that if you inherit stock, you don't pay the original price, or for tax purposes, the original price is actually meaningless. The important thing to note is the price on the day that that person died. So if it went from a penny to $100 before the person died, you're fine. Or your tax basis is $100. So look at that, and you only have to pay taxes on the capital gains since
from the date of death valuation.
Yeah,
that's it. That's a great point. And in terms of gifting to your children and having them sell it, we don't know how old your kids are. So, but I just want to remind people that there's this really nasty little tax called the kiddie tax. If you have young kids, you think, or maybe you're like, oh, I'll gift it to my 17-year-old who has no income. Then he'll flip it and sell it. It'll be awesome, right? IRS is on to you. The kiddie tax will not allow you to do that. I think the age went up, isn't it? 19, less than 19, younger than 19, and younger than 24 if you're in college full-time or school full-time. And basically, your kids get taxed at your rate, at the parents' rate, if you're basically still a dependent, generally speaking. And so they caught on to that one for a while. They used to be 14. That was good. Yeah, like a 16-year-old kid. Then it worked beautifully. All right, here is a last question here. This is an interesting one. This is D from California. I had to look this one up, Bob, I'll admit it. Regarding special needs adoption tax credit for tax year 2011. If the child was placed with us for adoption in 2011, but the adoption isn't final until January 2012, can we still claim the credit on our 2011 taxes, or do we have to wait until the end of tax year 2012? Do you know the answer to it?
Are you talking to me, Jill?
I'm talking to you, Bob.
Yeah, that's a tough one. I tend to remember that you can, I'm going to shoot from the hip here. I think you can take the credit this year. I know the credit is up substantially. It's up to about $13,000, maybe $150.
You are awesome. Wait a second.
Credit.
Hold on. We're just going to give you kudos. It's $13,170. That's amazing.
So, and I do think you can take it this year, and then if you have additional expenses in terms of finalizing the adoption in 2012 or even 2013, you can actually take the additional credit there. The other thing that's different this year is the fact that the credit is refundable, which means that it can exceed your tax liability, where in the past you could only take a credit up to the amount of your tax liability. So it is a very good, favorable tax credit now.
Yeah, and credit. This is not a deduction. This is a credit. So this is a really juicy one. I think.
And do they gain a dependent this year also?
Yeah, they must.
Okay.
They would definitely gain a dependent. The interesting thing is the credit and the exclusion from income. It's only going down at $12,170. It's not a huge difference, right? So, but as you said, this is the year. The last year where you can exceed your amount of your tax liability, right? So, I mean, of your taxable income. So that's kind of a one time only. So here's what happened. I went to go on the IRS website, topic 607. I know I've got it bookmarked now. And it's sort of, it's unclear. I know that's shocking from the IRS. First thing it says is, for expenses paid prior to the year the adoption becomes final, the credit generally is allowed for the year following the year of payment. So meaning that they could claim it, right? But then it says, a taxpayer who paid qualifying expenses in the current year for an adoption, which became final in the current year, may be eligible to claim the account. But so it sort of gives a slightly conflicting directive in a long, but I would say I'd go with the first one, which says, prior to the year, I'll take it.
It's a big number, and it is, as you said, conflicting. So I don't know this. Again, I'm shooting from the hip like Bob, but I'd be a little worried that it could be an audit red flag.
Well, I think if you're going to do this, you already went to I would probably go to an accountant and make this happen. Okay, last question. I'm sorry. Go, Bob.
I was just going to add to what Jack said. I know that the IRS is closely looking at all adoption expenses. It's just one of those areas that they're focused on, apparently because of past abuses.
Yeah, absolutely. Okay, hold on a second. Okay, Is it what question do you want me to answer, Megan? If the payroll tax cut? Okay. So if this is from Jason, who's in the chat room at MoneyWatch.com. If the payroll tax cut doesn't get extended by the end of the year, how differently would my paycheck look? Well, if you make 50 grand a year, you're going to end up seeing a little bit less every week, a total of $1,000 over the course of the year, right?
So depending on your pay periods, it's probably about $20, could be 40 for some people.
So it depends on, but so it's not huge, but it's enough that you might not get that extra latte.
To me, this is one of those things where at the individual level, it's actually not that big a deal. And if my priorities were deficit right now, I would say I don't really like this tax cut. But when you multiply that 20 or 40 bucks times every paycheck in the country, because everyone gets this at whatever level you're at, people tend to spend what comes in. It's not the best move from a personal finance perspective, but people tend to spend the money that comes in their paycheck. So this is probably mostly will get pumped right back into the economy. I mean, very few people are going to set up an automatic transfer where $20 every 2 weeks from their paycheck goes into a savings account, which is what sometimes happens with temporary tax cuts.
Yeah, but what we tried to do last year is we tried to convince everybody to just bump up their 401k contribution, right? So that would have been an easier way to do it, right? Just make it all, and you won't notice the difference. I know a lot of people needs money, so I'm not, but if you can afford it, it's awesome. Bob, before we go, what's the biggest mistake people make at the year end? What's the thing that they screw up coming into the end of the year?
Well, if you're going to mess something up at the end of the year, you're generally probably more affluent. And for those people, I would probably say it's just their failure to sort of get a handle on what their tax liability is. There still is some time to, take care of a few tax planning matters at year end. So, take a look to see whether you're subject to the alternative minimum tax, because if you decide to prepay state taxes, that could be a mistake. So I think it's just get a handle on your taxes before the end of the year.
My favorite is my friend runs a nonprofit, and she says getting the envelope that is postmarked after December 31st, but with December 31st written on the check. Like, you're going to really fool the IRS. It has to be postmarked by December 31st, guys, right? I mean, come on. Yeah, and Jack, you want to make sure you do the wash rule one more time.
Sure. And first of all, I will say, is whenever I tell people about this, they say, no, I don't want to sell it. I really want to get back to even on this stock. And that's the psychological mistake. Do not do that. Sell the darn thing. You can buy it back in 31 days. And that's the wash sale rule. The trick you can't pull is, I invested in a bank stock at 40, now it's 5. I'm going to sell it and buy it back tomorrow. You don't get the deduction in that case. But I don't think Bank of America is going to be back to 40 30 days from now.
Maybe what you should do is sell your J.P. Morgan Chase and buy the Bank of America. That is called a little bit of a, that's a different kind of it. No, what you should do is you should just make sure you don't buy substantially the same asset, right, within 30 days.
But there's a lot of latitude there. I mean, frankly, I think you can buy sell one index fund and buy another from a different company if it has a slightly different group of stocks. And
right, you could you could say, I'm going to sell the S&P 500 and I can buy the Wilshire.
Buy the Wilshire,
right?
exactly. Yeah.
Bob Meighan, I want to wish you a very, very Merry Christmas and a Happy New Year. We want to thank you so much for joining us. It's been awesome having you. And Bob is the head honcho at TurboTax. That's it. I'm just giving you that. And that's your new title. I can't read everything else.
Thank you very much, Jill and Jack, and Merry Christmas to you guys and Happy Holidays.
And Jack, as always, this is our last show of the year.
Wow, last one for 2012.
It's 2012.
2012.
Wow.
Oops,
what happened?
I'm jumping ahead. I'm waiting for that good market.
I guess you are. So you're going to make a prediction. You think the market's going higher in 2012?
I do, yeah.
Do you want to put a number on that, Mr. Meredith Whitney? How many failures?
Yeah, I'll only get it wrong, so no, I don't. And then
really?
I don't really, to tell you the truth, if you're just asking me as we're sitting here, do I think it's going to go higher? No. I think that the likelihood of higher is a little bit higher than it is to go down. And the only reason I say that is because I think there's so much bad news priced in there. Other than a European blow-up, I think everything else is priced in right now. Of course, as we know with all these predictions, something totally honest, the tsunami happens, right. The terrorist event, lots of bad things happen. So I wouldn't take this to the bank. Please, no one trade on that. But a year from now, I won't be angry at myself for saying now I think that we're more likely to get surprised happy than surprised sad.
All right, I think that's a good prediction. I like that one. Let's see. The Dow is like at 12,100. The S&P's at 1240. You know, I think we could see a single-digit 6-7% rise by the end of the year. I think even if there's a catastrophe in Europe, it would happen in the first half, and then you watch those printing presses run. I'm telling you right now, all those people in Germany who are like, oh, we're scared of inflation. That thing collapses, they are firing up the printing presses. So is the Fed. It will be like hyper liquidity. China's going to spend like a crazy, crazy country on fire. They're going to be all over it again. And stocks will, and every risk asset will go up eventually. Not, but, you know, first half of the year, high risk factor.
So we always say, of course, we've been talking index fund, but because it's the end of the year, so what's the best investment for next year?
Wow, I haven't even thought about this. You have to go first. I hadn't even thought about that.
Well, I don't know that it would be the best one for 2012, but the best one for, say, 5 years from now is going to be whatever, I don't know what it is, the ETF that tracks European stocks.
Really?
They are so cheap right now. You know, they're pricing in everything but default. So if we have default, then you're going to get a better opportunity to buy them next year.
Okay, I'll do one. I'm going to do SDY, the S&P Dividend Exchange Traded Fund. You know what? You will not go broke collecting dividends from really high-quality companies. You got to hang on. It's going to be a nasty ride. It's going to be a nasty ride. I'll tell you one thing that I can predict with certitude. It is going to be nasty out there. It is going to be volatile. But until then, enjoy your holidays.
and remember, when it is nasty, like in August, everything's going crazy. And as you said, and here we are exactly where we started the year.
Right. So don't worry too much. Don't fret too much about your money. And remember that we're always going to be here. So, you know, MoneyWatch.com, you can stay with us, and CBSNews.com. We're following every political story, every economic story, every financial story, and Jack's editing them all. So it's amazing. So thank you so much for joining us today. Merry Christmas, Happy Hanukkah, Happy Kwanzaa, whatever it is. Happy Solstice.
Festivus for some of
the
you,
rest of us,
you know, slightly older people watching TV in the 80s.
That's
you know,
right.
Yeah.
Festivus for the rest of us. Jack, I wish you the very merriest of Christmas. You are the best boss this year.
Oh, great.
Next year, if
how many have you had this year?
2.
Okay. All right.
So,
well, thanks.
There it is. Sorry, the other one. You're out of here. I'm not kissing your, you know what. And if you've got a question, feel free to send us a email. Very easy to do. Ask the experts at MoneyWatch.com. Ask the experts at MoneyWatch.com. I'm Jill Schlesinger.
I'm Jack Otter.
And we are delighted you've joined us. Have a very happy and safe holiday season.